There we
Good
go.
afternoon, everybody. Welcome back to another Stocks from Scratch episode. I am Brian Feraldi. Joining me, as usual, is Mr. Stoffel. How you doing, Brian?
Very good. I'm excited to talk about this company because the last 2 weeks we've been talking about companies where I've basically just had to say, this sounds great. I don't know anything about it. It's in the too hard pile,
But
but
this is a
not
company
this
that
time.
you are familiar with.
Yes.
Yeah, good. Because this is a company that I don't know well, but I know that you have been profiting from holding this company for quite some time now.
Yep.
So this is going to be a joy. Yeah, I totally agree, Brandon. So let's just jump right in. So today we are talking about Rocket Lab Corporation, RKLB.
Look at that chart over there
Look
on
at
the right.
this chart. I mean, so this
Here,
IPO at about $10 per share.
and you know what? Let me explain. I bought this in like January 24 at $5 a share ish. And then I sold it in September 24 because I wasn't willing to put the time in to learn about it.
Okay.
And then in about April of last year, I was watching some videos on the future of the space economy, and it totally changed my outlook on this. And I said, you know what? It's worth learning about this. So it was painful because I sold at 5 and I rebought at 25, right? I rebought after 5x'd, which is
That's hard to do.
that's
That's very
super
hard to
hard to
do.
do.
Oh, yeah.
And it is 5x'd since I bought back.
All-time high today.
Yep.
Looks like an all-time high today. This is a 4-bagger over the last year. Geez, you bought it 30-bagger over the last 3 years. And it came public in 2020, right? Not a good time for most companies that came public in 2020 are not up.
Look at how long it was red.
Let alone up big. Yeah, you can see
It was down 60% from its IPO at one time.
Company put its shareholders through. But anyway, I would argue that this is a 4 out of 6, 5 out of 6 difficulty rating with analyzing the stock. So we will do our best. But viewers, let us know. Is this a stock that you own? Do you own Rocket Lab? If so, let us know in the chat below if you are a current Rocket Lab shareholders. The point of this series is to let you know how we go about researching a stock like this from scratch. We use our own proprietary tool called Stock Simplifier to do this. There's basically 7 steps that we go through to get this process done. Now, today is a big day for Stock Simplifier because tomorrow we are debuting to our waitlist after months and months of work, the new version of Stock Simplifier. We are so close to being able to show it publicly. So tomorrow, if you do want to get access to that private webinar that we are doing tomorrow, longtermmindset.co/waitlist is how to get access to it. But with that, step 1 here is to figure out which of the 6 stages of the business growth cycle this company is in. Stage 1, stage 2, stage 3, stage 4, etc. This is a critical question to ask because it impacts the rest of the analysis that we do. So would love to know from the viewers, what stage do you think Rocket Lab is in? While we wait for those to come in, I'm going to go over to Stock Simplifier, and that's what we're trying to figure out. I have a prompt here that we built. Take this prompt. I'm going to load it into Gemini. And it's going to ask me what stock we're looking at. RKLB. And let's see what it says. That,
just so you know, Brian, I would say we've got about 2 or 3, 4 people who said yes, but most people are saying no, they do not own the stock.
Got it. Okay. So business phase analysis for Rocket Lab. Stage 1, the startup stage. Why is the confidence level there? It's only medium. So operating income is negative. So they are losing money. That's a good sign. Revenue growth is variable. It's a high growth company with volatile revenue growth, no capital returns, most useful valuation methods, forward price to sales, and the total addressable market analysis. So this is going to be an extremely hard company to value.
Yeah. If I had to choose, I would say stage 2.
Okay.
But stage 1 or stage 2. You got to remember, folks, that this company is still losing a lot of money, which is fine. That's what stage 2 companies are supposed to do. And it seems, so it all kind of depends on, we'll get to this, but they're going to launch their new rocket, the Neutron, hopefully sometime this year. Once they do that, they might actually go back to stage 1 because they really want to ramp up production.
Okay.
And it depends on how reusable it is, if it works the way it's supposed to, and all those other things. But it's money losing, but there's evidence of that moat being built. So I would stage 1 or 2.
Okay, well, money losing, let's go back to the general statistics about this. This is an $84 billion company, at least the $84 billion market cap company. Yep. So that gives them a lot of room to issue stock and to minimize dilution while they kind of fund themselves. Yep. So this is why knowing the stage is very important, because the analysis that we do from here on out is going to be very, very dependent on that stage. So stage 1 is what it says with, let's just double check it. So in financials, I do see we have a little bit of revenue, 600 million. So this number that looks pretty, I mean, it's growing.
Yeah, yeah. If you look at the growth rates, that especially quarter to quarter, they can be variable.
Okay, and this is operating profit. So negative 225 million, negative 228. Oh yeah, so this number was slightly down over the last 12 months.
It looks like it might be cresting, but again, it could dip negative, and that would actually be paradoxically a good sign.
So it could be in the startup phase. It could be in the hypergrowth phase. It's hard to tell the line that it's at, but we'll just go with startup for now to go with the rest of the analysis. Okay, so this means that revenue is quite small. The operating profit is expanding, and it's negative, so it's getting worse, and we might be getting worse from here. Next step. What does this company do? How does it make money? What are its key products and services? And then what are some qualitative metrics, like how often do customers buy? Can it raise prices? What happens in a recession? And more. Let's dive deep into that to get to know what this company does and how it makes money. What was it, 600 million in revenue?
Let me double check that.
Something like that.
Sounds right. Yeah, that's the right ballpark. It's currently at almost 700.
Yep. So what does it do? RocketLab is a vertically integrated space company providing end-to-end mission services. It designs and manufactures launch vehicles like Electron, HASTE, and the upcoming Neutron. This is what you were talking about previously. Yep. Spacecraft buses?
Yep.
And a wide array of satellite components, solar power systems, reaction wheels, and avionics. Company supports the entire mission lifecycle from initial spacecraft design through launch and on-orbit operations.
So one really important thing, on-orbit operations is recurring revenue. Just put that out there.
How is that?
Because they will maintain the thing that they designed while it's in space.
Are they designing these for other people or for themselves to get to space?
So they will design the satellites for you. That's the pre-launch.
Okay.
They will get it from Earth to low Earth orbit.
Okay.
So that's the launch. And then they will maintain it while it's up there.
Gotcha. Yep. Okay. So, and these are their
HASTE is this tiny but growing thing that basically they just they jerry-rigged an Electron, but it's specifically for government uses. Electron and HASTE are from 30,000 feet the same thing.
Okay.
Neutron is a big deal because Electron's tiny satellites. Neutron is like moving towards where SpaceX is.
Gotcha. All right. How does it make money? They generate revenue through a tiered model that blends transactional launch fees with long-term systems and component contracts. Space Systems represents the majority of revenue, shifting the company more towards predictable multi-year cash flows. So
you can see where the moat is there.
Driven by satellite manufacturing, component sales, and mission software. Okay, launch. So this is getting it into space, and these are, I mean, I imagine this has a backlog to it.
Yes.
And then, but this is the more exciting part of the business for an investor perspective, is more dependable, durable revenue.
Exactly. So they do, if we go into Physical AI, they do have a launch backlog and a space systems backlog. And that
Okay.
launch backlog is growing very quickly.
Where is it? Oh, launch backlog and space backlog. Okay. So the launch backlog is about 900 million.
Yeah, it's choppy, but if you look, I mean,
it's growing.
In the most recent quarter, it doubled.
Okay. And then space systems backlog. So this is everything else.
Yeah. And the thing to know about space systems backlog is that a lot of customers are waiting to see if the Neutron works.
Gotcha.
Right? Because you don't want to sign up for it unless you know it works.
If your thing is going to blow up on when it takes off. Yeah. All right. Who are their customers? The company serves a diverse set of high priority customers: government and defense, the U.S. Space Force, Department of Defense, and various intelligence agencies like the Golden Dome program. Okay, commercial satellite operators, companies building mega constellations, and imaging firms, and then academic and research institutions, universities, and international agencies conducting tech demonstrations. Where does it operate? They're globally, but they're heavily concentrated in the U.S. 70% of the value is in the U.S. Expanding commercial demand across Europe, APAC, and Middle East. Are those customers from those locations, but they're launching from the U.S.?
So they're customers for those locations, and then my understanding is that there's 2 sites that they launch from the United States, but then they also launch from New Zealand.
Oh,
because
okay.
Their founder is from there.
Gotcha. Okay. How often do customers buy? It's a mix of one-time and recurring revenue. Launch services are typically transactional, one-off events. Space system contracts are often multi-year, milestone-based, and space as a service, where they operate satellite for customers, provide recurring subscription-like revenue stream. The company uses its vertical integration to create high switching costs, such as customers using their components and design services, more likely to also select their launch vehicles. Yeah, that makes total sense to me. And that is a much higher mix of higher quality revenue than I was going to assume based on where the company is right now. Okay. Can it raise prices? They demonstrate pricing power through its unique position as a picks and shovels provider that manages mission critical hardware. Because it owns the launch infrastructure, Launch Complex 1 in New Zealand and US pads, and manufactures its own components, it's less vulnerable to external supply chain price shocks than competitors. The deep integration into national securities also provide a layer.
If you want to check something there on can it raise prices, if you go to Fiscal and just look at the gross margins and what they've done, I think that will tell a story all in and of itself.
I'm guessing that, well, we can definitely check. I'm guessing this is more of a factor of scale than necessarily price raisings. Right?
Well, there is another thing we can look at it later where they break out the cost per electron launch and the revenue per electron launch.
Okay.
The costs are coming down and the revenue is going up. And that's in
segment.
Yeah. So if you go down
cost per launch.
Yeah, there we go. Cost and revenue per launch.
Yeah. Okay. So about 5 million per launch, down from 9 million a couple of years ago. I mean, that's definitely the direction that you want it to go.
And then the revenue is going in the other direction, which is, I mean, that's everything.
Yeah. Right. Yeah. You want these 2 numbers to cross and be as wide as possible.
So it's getting wider.
In 23. Yeah.
So they make just like $3.7 million per launch.
Right. And I'm sure that number is going to get wider over time.
Exactly.
Okay, cool. Okay, what happens in a recession? So from a pricing perspective, the answer there is we don't know, but it's they have so much pricing potential just from scale and operations that effectively they can raise prices just through better operations. What happens in a recession? The company shift towards space systems and defense provides a defensive buffer. Launch services can be cyclical and sensitive to commercial capability, which now drives much of the space system backlog. It tends to be countercyclical and stable during broader economic downturns. They remain a high-value growth company, making its stock price susceptible to market-wide volatility.
Yeah. So even if the company is fine during a recession, the stock might not be.
Oh yeah, for sure. All right. Well, with that out of the way, what do you guys think of this business? Red is I'm confused, don't like it. Yellow would be, I get it, seems decent enough. Green, this is a business that is quite exciting and you want to learn much more about.
Well, I've known this about this for a long time. So while people tell us their answers in the chat, on whatever platform they're on, let me ask you, Mr. Feroldi, what do you think?
I'm going green because if the business was launch, get paid, and that's it, that to me is a much less exciting business, but one when you are launching, it's a semi razor and razor blade business.
Yeah, exactly. Yeah. It actually reminds me a little bit of like Intuitive Surgical.
Mm-hmm. Yeah. The only difference is Intuitive Surgical had no company that was 20 times their size above them. But this business, no doubt, better than I thought it was going to be before we started this.
Cool. Yeah. I would say mostly a mix of yellow and green. We had a red in there, which is fine. I mean, this
totally
is
fair.
This is all
At least we know what the company does now. Moat. Time to take a look at this company's moat. Does it have one? And if so, what's the source? So network effects, switching costs, low-cost producer, intangibles, or counter positioning. We want to know what the current moat size is and the current moat direction is. Curious for those that are watching, if you were to guess if this company had a moat, what its major source would be, what would you guess is the current state of this company's moat? I'm going to take the prompt. I'm going to get this loaded, and we'll see what
would you say for this?
So this is narrow. I was going to say probably no. No might be too harsh. I'd say narrow is probably fair.
There's only 2 companies that do this.
Right. Exactly. So if you exactly, there's two major companies that do this. This is definitely the Pepsi to SpaceX's Coke. Right. But I would say that the widening thing is the key thing, the direction here. All right. So switching costs, definitely. Once you're a customer and you get your thing up there, who are you even going to switch to? And then intangibles, much less so. Well, they might.
I think intangibles for the government contracts, the launch pads, the
relationships.
And here's the big thing. This is something that I did not appreciate at all. Like, I did not think this was a big deal at all. Can you guess, Brian, if you want to send something into space, what is the most important thing other than reliability? Because of course you don't want your payload to explode. What's the most important thing to you?
Cost?
Timing. Timing is everything. Yeah. Like if you can reliably say we'll have this in space in 3 weeks, that's the whole ballgame. It's everything, because it's not like you can just catch a taxi up to space.
Gotcha.
And that is something where I would say that's probably an intangible asset. And I underappreciated how important that is. And they have contracts with the government where, here's the deal. They say, we're going to say sometime in the next 2 years that we want to launch this. And our test is, can you put 2 satellites into space on separate launches within 48 hours? And they've successfully met that. Like, that's a big deal.
When you think about the development time too, that you probably don't have, you don't want the delay to be, okay, this thing is ready to go. Now we have to wait 6 months before we can actually put it up into space. Okay.
Exactly.
Fair enough. So RocketLab successfully transitioned from a small launch provider to a vertically integrated space system partner, a narrow but widening moat. So this is very much the classic disruptor, right? It's like you start small niche market and then you kind of expand from there. So they started with very small satellites and they're growing from there. Its ability to embed its own components and subsystems into customer satellites, thereby increasing customer dependency, has driven a record $2 billion backlog and significant margin expansion with a gross margin of 38% already. Believe it or not, that's very impressive for a start.
Yeah, no, that's really good.
It's this early on. All right. Switching costs. They're narrow, but they're widening. Their move towards vertical integration means that once a customer utilizes their system, software, and components, the friction to switch is significant. They become a strategic partner and they embed themselves in the customer's. Yeah, no doubt about it there, right? Once you are a customer. Yeah. This vertical integration reduces dependent on the launch cadence alone and creates recurring revenue stream. Very good to see that. Okay, intangibles. This says narrow and stable. The company has a strong brand identity with its reliability and precision, which is highly valuable to U.S. space agencies. Regulatory advantages, yep, meaning barriers for entry for smaller competitors. Yep, I would say that that's fair.
Dedicated, and I'd say that reliability, that's the timing part.
Network effect, yep, no network effect. Low cost production, I would say that SpaceX is probably the lowest cost producer.
Oh, they definitely are.
Counter positioning seems like the same business model.
What I will say for counter positioning though is that everybody wants there to be more than just SpaceX.
Sure.
For obvious reasons.
Sure. Competition is good, right?
Yeah.
It's more of a matter, do they have counter positioning against Lockheed and Northrop Grumman and the big incumbents? Okay. So execution risk, startups like Firefly and Relativity Space and SpaceX value. Yeah. Morningstar does not assign a rating, making it because of the stage of this business. No to narrow moat. Yeah, I would say that's fair. I'm gonna go with green. Yellow. It's mostly for the developing part, not necessarily for what it has right now.
Yeah.
Okay. Next, take a look at the company's growth potential. Does this company have long-term growth potential? If this isn't green, we should just stop right now.
So this is the hardest thing because the predictions. Oh, it's definitely green. Don't get me wrong, but the predictions for how big this market could be change every week. And I don't know if you've read the SpaceX IPO, but someone correct me if I'm wrong, but because I read over it, but my brain wasn't working. I think that they said it's like a 30-something trillion TAM.
Yeah.
How do you parse that out?
That's the GDP of the US, right?
Yeah.
It's like this is going to be. You have to look at. There's no way you could look at this and be like, what's the value of what's the total addressable market of the internet in 1995? It doesn't matter what the number is because you knew that the whole market was going to explode over the next 2 or 3 decades. I almost don't care about the company's TAM today. Same thing. If it works, the TAM is unlimited. If this investment does not pay off, it's not because of opportunity.
No.
Anyway,
28.5 trillion. That's what SpaceX said its TAM was. 28.5.
Wall Street is saying forward revenue growth of 45% over the next 2 years. Nothing on earnings, which makes sense, but it's really the revenue growth that makes sense. Keep in mind, this is a company with under $1 billion in revenue, right?
And valued at almost, we're approaching $100 billion.
82 billion in market capitalization compared to SpaceX's estimated 2 trillion. But okay, what are the growth drivers of that going to be? I hope that this picks up Neutron, as you said, as a potential growth driver. Let's see what Gemini says.
I'm curious. Because it changes every quarter.
Okay. So growth drivers, number one, marketing and sales signed 31 new launch contracts in 1 quarter, the highest in the company history. Great. New distribution channels, transitioning from transactional launches to end-to-end prime contracts, winning high-value contracts previously held by legacy aerospace firms. So they're taking market share. Market expansion, established its first European footprint with RocketLab Europe, followed by Myanmar acquisition. Some acquisition. Yeah. Significant traction in the National Defense Agency, the Golden Dome program. Acquisitions. They closed on an acquisition, entered an agreement with Motive Space Systems for robotics and precision mechanisms. High value capabilities in-house. Pricing power, moderate. This number can continue to go higher just with scale. New products and services, introducing Gauss electric satellite thrusters, ongoing Neutron.
The Neutron is the big one. That's the huge one.
Okay. Neutron Neutron. Plus 5 dedicated Neutron launches signed. So they're already signing contracts.
Yep.
Against this new one across the Neutron program, medium fit.
They've been very clear that they will delay as many times as possible, or as necessary, not possible, as necessary to get the highest percentage of this first launch working.
Reusable fairing system. So they're going for reusability too.
Yep. This is the SpaceX playbook all the way.
Okay. And any idea when that's going to be coming out, or when's like the estimate is?
So a year ago, I would have said it would have happened by now.
Okay.
Right now, they're saying by the end of the calendar year.
Okay. Well, even this year. So this unlocks all kinds of new revenue opportunities.
Huge.
Yeah. Okay.
Triple, quadruple, quintuples their TAM.
Customer retention, their backlog is enormous. 20% quarter over quarter, high contract renewal and multi-year commitments. Strategic incessant acquisitions are number one. Probably not.
But the thing is it's not number one. It's the new products that's number one. Acquisitions do matter, because if you're vertically integrated, that's where acquisitions make sense.
Yep. 63% year-over-year growth. Geographic market expansion, launch services. Yeah. So tons of growth potential, with the key thing being Neutron isn't even here yet, and it's already generating backlog growth, which we'll concede there. I can't imagine.
I don't think we need to vote on this one.
If we asked everybody and you didn't say this company has great long-term growth potential, I don't know what is. Okay. Now comes a tricky part, because we have to look at key metrics for this business. Remember, it's a phase 1 company. This is the phase that it's in, startup. So like the revenue growth might just be starting. As a result, we can't look at a whole bunch of key metrics, but we can look at revenue. Is this number positive and growing? We've already looked at this number, but we will take a look at this number. So is revenue positive and growing? Yes. Yeah. Right. It's growing. Pull it out too. It's growing 50-ish% per year on a compound basis. Yeah. Is this number positive and growing? Sure is. Gross margin. Bad sign if gross margin is negative, good if it's positive, and really good if this number is positive and expanding. So we already take a look at this, but gross margin here, gross profit margin, definite progress there. So gross profit margin was negative in 2020. Now it's just expanded 36% in the last 12 months. And I think it was even 38% in the most recent quarter. That is definitely a good sign. Cash runway. This is a good number.
We don't get to do this that often.
We really don't. You want to explain what cash runway is?
So the idea here is you've got a certain amount of cash. That's like your runway. And then you've got the amount of money you're losing in free cash flow every year. That's like how fast you're going down the runway. And you want to say, well, how many years of cash do we have left? So we'll pull up. We see that they've lost about $320 million. See, that's why I think they're kind of starting phase 2, because they're
hard to say. You can't make a trend out of that.
You can't,
especially with more expenses on the way for their new launches and stuff.
But if we look at it, what do we see? So they're
$300 million in, call that 320 million in negative free cash flow. So that's their current annual burn, but we have to compare that number to their cash and cash equivalents. So 1.3 billion in, do they have any long-term? Yeah, about another 100 million. So call it 1.4 billion. So 1.4 billion in cash divided by 300-ish million in free cash flow, 4 years.
Now, I will also say earlier last week, I believe they set up a plan where they have the right to raise, I think it's up to $3 billion more through,
I would say,
share offering. Which is exactly what you should do when the stock is this
100%. Now would be the time to do that. This is a company with a stock that's very richly priced, right? This is why, by the way, if you're a fan of this style investing, the investor to focus on and pay attention to is David Gardner.
Yeah.
He is a very big fan. You want to find companies that are overvalued. As backwards as that sounds, the reason you want to look for companies in this stage that are overvalued is they can raise capital and not give away a ton of equity.
Exactly.
So $3 billion would be dilution of 2%, 3%. Totally reasonable, like extremely reasonable.
Yep.
And that would buy this company at current spending 10 years of extra runway.
Yeah,
that
like 10 years.
That is a trade-off.
That's a trade you always make.
I'm sure that I'm almost positive their losses are going to grow from here, right?
They will, because they're going to try and meet demand.
Yeah. The bigger point is, when we're looking at the balance sheet, does this company have plenty of capital to fund itself for 3+ years? The unequivocal answer there is yes. Unless operating loss triples sometime soon. From a balance sheet perspective, pretty good shape. Okay. Next, revenue versus estimates. Revenue, not earnings. We want to see that the company consistently outperforms its revenue expectations. So if we go into estimates and we focus on revenue, this is what we're trying to pay attention to. So actual.
So this is just so you know, this is annual. If you want to put it on quarterly, that might.
Yeah, let's go to quarterly. All right. So we're going to focus on the actuals. So the estimate was 190 million, actual 200 million. Actually, we can just focus right down here. It was a beat.
1, 2, 3,
beat. That's 6 in a row, with a little bit of misses kind of back here. But as the number of analysts have gone up and the accuracy of the ratings has gone up, so has the numbers. And look at the size of the beats. They have gone.
I mean, look at the last one, 5-6% beat.
Yep. I don't know about you. I'm willing to give them full credit for that. So is the revenue exceeding? So far, always. Now comes a dilution question. Anything more than 7% is where you start to get a little icky. 4 to 7% is moderate, and less than 4% is okay.
Now, let's just explain for a second. Those are some pretty high numbers there. The
extremely
reason
high.
we're willing is because this is, again, stage 1. Like that's just kind of the price of doing business.
Yeah. All right. Now, when did they come public? 2021?
Let's see. I'll look it up.
Yeah. I think it was actually 2020. I think it was 2020. But anyway, this would be the fully, and then
it was 21. It was the SPAC was available in 2020, but the reverse merger happened in 21. Okay. I would go based on starting in December 22, because it'll give us an idea of what that run rate might be.
Yeah, we can also look kind of like quarterly.
Oh, yeah, that's good.
Yeah,
and we're above that threshold.
If we pull it back to when there's a massive jump. So they get public here. So December of 2021. Yeah. So what is the compound annual growth
rate?
At
that
7%.
Yeah.
7% growth. And it looks
probably going to go up, continue going up.
Look at it's accelerated recently. So 70 million extra shares outstanding. So this is them hopefully taking advantage of the share price that they see. So this is probably all stock-based comp, and then it goes up. While we're here, let's take a look at stock-based comp. I'm guessing it's going to be high.
No.
Yeah. 100 million-ish. Not crazy.
I mean, it's under 80. It's under 80 million
for a company of this. Okay. So I'm going to say that it's over 7%.
Yep.
It's what I'd expect, right? They are diluting shareholders. I think of that number as a negative growth rate. So instead of them growing at 50% per year, they're growing at 40% per year. Like that's the amount.
Like it's revenue growth per share.
Correct. Revenue growth per share is about 7% less than it would be otherwise. And as we said, this is a trade-off that investors should be totally fine with
every day
right now, given the phase that this company is. So overall, pretty good on the key metrics perspective. All right, moving on. Let's take a look at risk. Boy, I wonder if this is going to be a risky company. I wonder if there's going to be execution risk here.
Yeah, I mean, Elon has done a great job for those that are paying attention of normalizing rockets exploding.
Yeah.
Like he's done a great job at showing that is just part of the process of learning.
Yeah.
That said, if the neutron explodes on its first one, I'm assuming it's prudent to prepare for the stock to fall 20-ish% if that happens.
You just have to go in eyes wide open.
Yeah.
It's not a reason to do it or not to do it. It's just know what risks you're taking on. That's all.
Yep.
So the primary risk is neutron vehicle launch execution. cash burn and liquidity requirements. And then their mitigating factors are their backlog, their growing space systems, and their liquidity. Okay. Concentration risk, yellow. While the company is winning new contracts, a significant portion of the billion is tied to government and national security customers. 49%. That's actually not as high as I thought it was going to be. They're dependent on the U.S. Space Force, Department of Defense, creates exposure to legislative and budgetary shifts. Okay, fair enough. I wouldn't say that that's too high of a customer concentration risk, but at least it's not surprising given the stage that this company is in. Disruption risk, none. They are the disruptor rather than disrupted. By vertically integrating, they're providing end-to-end mission services. They're actively shifting the market from traditional slow-moving prime to faster satellite-agnostic launch and deployment. Outside forces, significant exposure to geopolitical and regulatory dependencies, particularly a U.S.-listed firm operating major launch facilities in New Zealand and navigating ITAR-controlled technology. I don't know what that means. ITAR, can you look that up? Continued growth in government contracting links revenue visibility directly to U.S. spending, defense cycles, and policy. So outside forces, definitely. Competition. The space industry is becoming increasingly crowded. RocketLab dominates small lift. It's entering the medium lift against SpaceX. So Neutron is going to start bumping up competition against SpaceX.
Well, I mean, so SpaceX is moving large. So SpaceX, think of it this way, like RocketLab started here and they're moving here. SpaceX started just a little bit above and they're moving up.
Yep.
But they are going to butt heads.
Okay. Good to know. Anyway, Neutron is the thing to, is this a bet the company program, you think?
Well, so for the company, no. But if you're an investor, yes, because that is factored in to the valuation today.
Sure.
For sure.
Okay. Concentration risk is moderate. Disruption risk is very low. Outside forces risk is red. Competition risk is red. High capital requirements due to the Neutron launch vehicle places pressure on margins. They're offset by the company's existing business model and their predictable revenue streams. They have a vertically integrated position. They've got $1 billion in cash. Their backlog is going up. All right, what do you guys think? Red, yellow, green. Is this a high risk investment or high risk business? Let's high risk business execution. Yellow, medium business risk execution. Green, low risk business execution. Don't focus on the valuation. We're just focusing on the execution of the business itself.
Yeah.
$30 trillion. Wow. Yeah, you're right about that. You're definitely focused on the number, which is enormous for their top.
We got a lot of yellows and reds. Here's what I would say. If you're just focused on the business, I would say yellow because the Electron works. I mean, they launch this thing all the time. If you're talking about the stock, because we haven't talked about valuation yet, I would say red. It's literal rocket science. They have not put the Neutron in orbit yet.
I'm agreeing with most people that said red here. If you think about the difficulty of running a business and executing a business, it doesn't get much harder than this. Maybe biotech to me is easier than this. Like if you think about, running a restaurant or running MasterCard, pretty easy. This pretty darn hard. This is definitely a high risk business. Okay. Up next is going to be valuation. Valuation risk. Talk about a hard company to value. Now, when you're in the startup phase, it's best to look forward at forward estimates and specifically forward price to sales estimates. This is going to be a just to the right of useless analysis, but better than nothing. This is better than nothing valuation analysis.
We could do price to gross profit just to look at it.
Sure.
Don't give it too much weight, but just to look at it.
Yeah, you really have to do, if anything, you have to do market cap analysis. This is an $80 billion company. If everything goes well, could this be an $800 billion company?
Yeah.
Do you think that's in the potential range of outcomes? If you do, that's your upside potential.
Yeah.
Again, SpaceX is a $2 trillion company. So SpaceX is it 20 times bigger? Yeah. SpaceX is 20 times bigger than this, or assuming it comes public at the number that has been in the headlines there. All right, let's go to ratios, financials ratios, and trailing ratios are going to be useless to us, even more useless, but forward valuation numbers. So forward price to sales, this is going to be pretty much as good as it gets. All right, so this is when they started generating revenue. That's kind of useless to us. So we'll pull this forward to December of 2021. This is when they went public about 24 times forward sales. They got down into the low single digits on a price to sales basis. Currently 80 times next year's sales. And I can't bring that out anymore. So all-time high stock price, all-time high valuation. We can also look at price to gross profit if you want, but this number is going to be even more useless to us than even price to sales. Price to,
you could go up a little bit up.
Right under there it is. Price to gross profit. There it is. 3. Yeah. So useless.
Pull that forward.
This is when they were becoming profitable. So 336 times trailing gross profit. I mean, I don't know how you can look at this stock with a straight face and say, boy, shares are classically cheap. They're not.
You have to do a TAM-SAM analysis on 100%. This. And the problem is, this is what I started out with. The TAM is constantly shifting upwards, which is good. But I remember I called RocketLab expensive. I didn't sell it, but I called it expensive like a year ago, and it just exploded upwards. And that's where I was just, it's almost like you can't make a valuation call on companies like this.
Well, we can tell you this. What's the drawdown on this thing? Okay, this stock has already fallen 83% once. I don't know. You could do that. You can highlight.
I didn't either.
So this stock, if you bought it at IPO, you lost 80%, 82% already. And then it fully rebounded. And
but just look at the last 2 years, it's fallen 50% 2 or 3 times.
Yeah. I mean, look at this. Exactly. In the last 2 years. And this is after it went on a sensational run. During this sensational run, it's fallen 50% 3 separate times, 80% already once from the IPO. I mean, just go in eyes wide open. If you wanna take a flyer on this company, expect extreme volatility. Yep. Extreme volatility. Again, I'm not going to ask the audience because there's no way that you can look at this and say it's not insanely overvalued, which again, ironically, is something that should attract you to this company because they can raise money. Capital with minimal dilution to you as a shareholder. It's basically opposite. When you're investing in phase 1 and phase 2, you have to emphasize the business. Like 95% of your analysis should be the business. 5% should be focused on valuation. When you get to phase 5, capital return, flip those, or 50% should be valuation, maybe even more, and then 50% should be business. In the startup phase, valuation has to be, you have to think like a venture capitalists. Venture capitalists almost don't care about valuation.
Yeah.
Right? Yeah. All right. So with that, let's go ahead and do some sentiment analysis. So we have
I have to believe this is green across the board. I mean, it's up 70% in the last month.
Well, you never know with the media in particular. They might be saying,
well, you know what the big thing is that we haven't even talked about, that Burkhart talked about, is
what?
SpaceX.
Right.
Going public in 2 weeks.
Okay. Why? Yeah. So that might be causing the interest in this stock now, right? It's a chance to buy not SpaceX, but get into the space economy. They soared following a perfect storm Huge revenue growth, big backlog, aggressive expansion into high margin, overshadowed the temporary selling pressure from a $3 billion equity offering. Oh, so that was an offering.
Mm-hmm.
So they already did that? Or is that just an announcement?
No. See, I think that I think the timeline on this is wrong. That offering happened after the quarter was over.
Okay, makes total sense. No. Following the completion of the record liquidity, following the completion of an after the market offer, plus business updates since then. So they've already done an additional $2 billion in liquidity. So maybe that was part of it. In which case,
it wouldn't have shown up in the data though, because it was since March 31st.
Correct. So they made an announcement about that? 90 million contract acquisition. So you said they had an announcement about that?
I thought it was on the 20th. That's what I saw.
20th?
Yeah.
I don't see one there. Maybe they did some kind of either way, it just furthers we have plenty of liquidity offering. Okay. The next catalyst is continued flight and the Neutron medium lift rocket. Wall Street seems bullish. Analysts are bullish. Yeah, there you go. Investors seem bullish. The media is positive. Analysts have upgraded it, citing their strong operational momentum, defensive wins.
Brandon's right. It was 2 separate offerings. Like they see that stock price where it is, and they're just going to the bank. And that is exactly what they should do.
So they've added $4 billion in addition to the $1 billion they have. So this company has $5 billion in cash.
I think it might be $4 billion more than what was on there.
Okay.
$3 billion more than what we were aware of when they reported earnings.
Well, then again, the whole
that's what you should be doing.
Absolutely. Does this company have the capital it needs to fund itself indefinite for a long time? Absolutely. So they have the bears say, hey, this is too expensive, too much dilution, and they're small when compared to SpaceX. They're not as dominant as it seems. Okay. One other thing that we can do is take a look at the management team.
Now, Brian, before you do this, we've had a lot of people on this stream who are from Stock Investing Mentor or from the long-term mindset community. Just to clear things up, the product that all of you already have access to is Stock Simplifier 2.0. You have been our beta testers. You get it for free for being part of our
community. Thank you for beta testing it. Yeah.
Yes. So on Wednesday, when we release it, it's not that you are the ones who have helped create the product that's being launched.
Right. This is the first time being available to people that aren't already inside our other premium offerings. But let's take a look at the new Stock Simplifier and how it thinks of the management team. So AI gives it a 5 out of 5.
I do too. Dr. Peter Beck not only is a very intelligent individual, but he has an awesome accent, which will lull you into believing everything he says.
2 years of 100% mission success and growing revenue 10x since going public. Execution record speaks clearly. 21 launches at 101% success rate. Revenue 10x. Gross margins are positive and the largest contract in the company's history. Strategic bets extend the core. Every major investment pushes into larger markets rather than diversifying away. Capital goes where it compounds. Skin in the game. Vec voluntarily cut his salary to $1, signaling deep conviction in the long-term thesis. Okay. Now this says he only owns 0.16%.
Yeah, I'd have to go in and double check that.
So the way that we have program stock simplifier is it goes into SEC filings and it looks at just common stock ownership. So you should look at this as like the minimum amount, not necessarily, because if it's held in a trust, it's usually outside of what we can detect.
If it's a different class.
Correct. If it's a different class. But if you could look that up separately, he owns at least $60 million worth of stock. Self-taught engineer from New Zealand. He's a tool and die maker. He founded this company in 2006. No degree.
It's in a trust. He owns 7.5%.
There you go. Okay. So this only detects direct common stock ownership. We're working on looking through like trusts and things like that. Okay. So he has mega skin in the game.
Yeah, like this is at least $5 or $6 billion.
Built the company from sounding rockets to 75% successful orbits. Led the pivotal end-to-end space company, winning the direct contract. Do employees like working here? 93% recommend the company, but long hours and the intense pace are consistent criticisms. Do they beat expectations? Absolutely. We've seen them beat expectations. Are they shareholder friendly?
Not
Hard
yet.
to judge at this point. Not really
It's kind of
something.
like, is shareholder friendly giving you money, or is shareholder friendly being sure you survive into the future?
Yep.
Like that's the real question.
And then our margins improving? Definitely. They're definitely improving. Now we have this really cool feature here called deep analysis that goes way deeper into the details behind that and gives you some more information about it. But overall, you think 5 out of 5?
Yes, absolutely.
Great. So they do have a good management team. And again, that version, the new version of Stock Simplifier, stocksimplifier.com, launches tomorrow, only to the wait list, people that are on the wait list. If you want to join the wait list and join us for a special private Zoom session tomorrow at 12, where we're going to go over all the details of Stock Simplifier, Stoffel, if you could share the link in the chats, that would be
well, yeah, I want to see what people have to say, though. I want red, yellow, green. What do you think of RocketLab?
Absolutely. So
I have a feeling I know what is going to be what people say. So let us know in the comments section for RocketLab, red, yellow, green. But Brian, what I just want to talk about.
Let me review everything that we learned.
Go
about.
ahead.
Good point. Okay. Definitely an exciting business. The moat is starting. It's hard to assess the moat right now, but there's no doubt the moat is getting wider. The long-term potential here is fantastic. Very surprising to me that this company is positive and growing its revenue fast. Its gross margin is already positive and expanding. Plenty of cash. They have consistently exceeded expectations, and the dilution has been the negative here, but it's about what you would expect. The execution risk here is very high. Valuation, which is admittedly extremely hard to do for a company at this stage of its growth cycle, is very high. But ironically, that's actually what you want to see for a company like this, because it gives them the ability to sell stock at very reasonable dilution. And one of David Gardner's principles of a rule breaker, Stoffel, is strong past price appreciation.
Yeah.
And that looks like strong past price appreciation to me. All right. What's the overall consensus from people?
I'm a little surprised. We got some of all three of them, but green was actually the one that had the most votes. So I just want to talk real quick about what could happen with SpaceX. Because right now, I mean, if you go and look at the stock market today, every space company is going up and up and up and up. Planet Labs, Intuitive Machines, they're lunar, I can't remember what it is. They're all going up. Mm-hmm. And I think that SpaceX is a huge part of that. It is worth noting that I don't know if this will happen, but when SpaceX goes public, the money to buy SpaceX does need to come from somewhere, mm-hmm. right? Like, people aren't just creating money in their basement, going to their broker and buying. You could see, I think either you could see a sell-off in some totally unrelated part of the market, or you could see a sell-off in other space names because they're allocating towards SpaceX. The bigger picture to me is how we will have, over the next 2 years, we'll have a lot more information about the TAM for the space economy. And if that TAM is what the bulls think it is, SpaceX going public could be a very positive development for RocketLab.
Yep. I think Susanna here is dead on. This to me is a lottery ticket. It's a lottery ticket where a couple of the numbers have been scratched away, and they're showing winning numbers so far.
Cherry.
Yeah, exactly. It's probably one of 3 cherries so far, something like that. But if you're looking for a roll the dice, I want to get a 10xer. I'm interested in a phase 1 company. This is quite impressive.
Yeah.
Given where that it's at. You are a shareholder, correct?
Yeah. So full disclosure, I'm checking right now. This started out as a very small position, but it's up a ton. So it is now, believe it or not, Brian, and this was not the case just a couple of weeks ago. It is now a 10% position.
Okay.
Because it's just grown so much.
There you go. So 10% of your net worth is betting on this going up.
Yeah. I might need to trim that down a little bit because this is a phase one. That's not typically what you want at that allocation, but it grew to that.
It earned its spot in your portfolio from a tiny position. This is not a stock that I own. This is too early for my taste. And given I'm a huge fan of Elon. I've been a Tesla shareholder since a year after it came public. I drive a Model Y. The SpaceX valuation gives me the heebie-jeebies, and there's so much press about this thing. There's no rush into IPOs, in my opinion. There's no rush. I'll wait a year before I take a hard look at SpaceX. And if I miss out on upside, so be it. You want to buy into these things when nobody wants them, and right now everybody wants them. So anyway, that's my view. But hey, if you want to take a flyer on this company, I understand. I understand why. It's a much better business than I thought it was going to be.
Yep. Totally agree.
Thank you guys so much for joining us this week. Next Tuesday, we will finally be able to show off on this live stream the entirety of the new stock simplifier from start to finish. This is something we can't wait to do. I think we're doing it on Palantir. We'll see if we can get SpaceX into stock simplifier early. We won't have any valuation data to go off of, but perhaps that could be. But we're going to do Palantir, which is a company we've been waiting to do live in the new stock simplifier. So join us for that. So until then, thank you guys so much for joining us, and we'll see you next week. Bye.